Hello and welcome to FidelityConnects. I'm Pamela Ritchie. Markets and currencies are speaking up in a negative fashion this morning, chucking snow on hopes for a Santa Claus rally, which takes us back to whether we are in the midst of a cleansing moment in the markets or in something more indicative of a step downward after a truly winsome year for global equities. Could the volatility over the last few weeks be called a healthy pause or something more closely associated with the bubble trope that we keep hearing about? Joining us now to discuss the strong fundamentals currently underpinning this rather edgy market is Fidelity Director of Global Macro, Jurrien Timmer, live from London. Welcome. Great to see you.
Yes, good. Good morning. Just arrived in London. I was in Hamburg for a few days, and before that, of course, in Holland, where we did the show from last week. And so this is the final stop. I'm here for a conference tomorrow. But so anyway, a little disheveled, but all good, and we're ready to go. So.
We're delighted that you fit us in. That's a busy calendar that you're holding right now. And actually, you've got a calendar behind you there. I see you've got
I've got an advent calendar.
An advent calendar going. Have some chocolate. Let's ask you about Bitcoin, actually, just to get going here. You mentioned even a couple of weeks ago that Bitcoin getting down to sort of 80K wouldn't be terrible necessarily. It's on its way. What do you think?
Well, so it fell to 80. So it reached 125,000 in October. And it went down to 80, and then it popped up to about 94, and now it's kind of getting closer to that 80. I would say big support is around 75. That was the previous peak. But of course, you're going to get the inevitable questions, right? So all the Bitcoin fans, at 125 were like, well, it's going to 150, of course. And now, it's substantially lower. And I don't have the chart this week, but I promise I'll have it next week, where when you see, and actually we can pull up slide 13 here, but you can see if you pull up a chart all the way from the beginning, which this one doesn't do, you can see that every advance, the slope of that advance gets less steep for every bull market, every 4-year cycle that Bitcoin achieves. And that, of course, makes perfect sense because the adoption curve, flattens out. I mean, it's still rising, at a pretty strong pace, but the slope is flattening out as the adoption matures, as it would for any network asset. And so now all of a sudden we're down, and people are wondering, and you can see that uptrend line being broken there, whether the 4-year halving cycle actually has been completed, and that we now have another, I don't want to call it a winter, because I again, as the advances become less pronounced, which this one was, right, the decline should become less pronounced because Bitcoin is just becoming an adult, if you will. And I think part of the story behind it is, maybe the stable coins now becoming much more mainstream and becoming the rails on which to build a lot of this blockchain infrastructure. Ethereum actually kind of is the token for that. And so maybe some of the allure of Bitcoin that was so prevalent a few years ago is losing a little bit of that support just because we have digital money. I mean, we've always had digital money, but there are other players in the room. But I'm still a fan. I think from a store value point of view, Bitcoin and gold are still the two players that I want on the team. But the store value story right now is not as urgent as as it has been in the past. So I think Bitcoin just takes a backseat. You do see there in the bottom that the Sharpe ratio and the momentum curves are showing that it's sort of in the buy zone. And actually, if we go to slide 12, I've got the exact same chart for gold.
Interesting.
You can see gold is positioned exactly on the opposite side of that. And actually, if we take it one step further and we go to slide 11, if you add up, if you show all the Sharpe ratios, right? So the 52-week return divided by the 52-week volatility, and obviously it's a squiggly mess there, looks like a plate of spaghetti. But what you'll see is for the 26 asset classes that I track, the outliers are gold at the top and Bitcoin at the bottom. And I don't want to have to choose. It's like choosing between my children, but it is interesting to see that they are on opposite sides right now, where gold has corrected, but it's holding 4,000 pretty easily. And Bitcoin is sort of living up to that reputation of, Dr. Jekyll, Mr. Hyde, where it's gold or it's digital gold, but it's other things as well. And one of those other things is a speculative asset, unfortunately. And of course, all the speculative corners of the markets have been shaken out in recent weeks, and Bitcoin certainly has been one of them. And maybe it continues, maybe it doesn't. But again, I'm not in Bitcoin as a short-term trade. I'm in there for the long run. And if we do get towards that 75, I'm gonna be taking a pretty hard look to maybe add some exposure.
It's interesting. Does Bitcoin become the bonds of digital assets?
I think Bitcoin just, it's the use case. So Bitcoin's trying to be money, right? And I think by now it's won that battle that it is money. So money is a unit of account, it's a medium of exchange, it's a store of value. And so obviously the dollar, as long as you put it in a productive, used in a productive way, meaning it's earning interest, that's a store of value, it's a medium of exchange, it's a unit of account. Gold is all of those things as well, although no one's really using it as a medium of exchange. And Bitcoin, I think, is become like gold in that sense. But before stable coins were really a thing, or all you had was Tether, which is a little bit, nobody exactly really knows what it is. Bitcoin really had a use case as if you wanted digital money and you needed to have it in far-flung places around the world, Bitcoin was your thing. And now you can really just do that with stablecoin. You're owning dollars, but you're owning them digitally. So if you're in a country that has a weak currency, Bitcoin, yes, stablecoin, like what's the difference at that point? And so I think there's a little bit sort of an identity, not a crisis, but an identity moment there that Bitcoin's dealing with.
It's fascinating, and it's a little bit maybe of a. I was going to ask you a question about your breadth discussion and equities, and if in fact there's a little bit of a potential for a changing of leadership rather than a crash of markets, or if that's one of the options out there. Maybe Bitcoin's going through changing of leadership a little bit within the digital space as well. But it does feel like there's some changes of leadership that are at least floating out there as possibilities. Could you take us to the equity story on that?
Yeah, of course. But just one final point on
Sure.
Bitcoin now that you mentioned that. So I do think in the way that gold used to trade sort of as a pairs trade against silver, right? So we'd look at the gold to silver ratio, or we would look at the gold to the gold miners ratio. I think Bitcoin has become legitimized enough that it will be looked at in the same way by investors, institutional investors, hedge funds, even regular end investors. And in that sense, the divergence between gold and Bitcoin ultimately will prove to be of benefit to Bitcoin, because if someone's holding a lot of gold and has concluded that Bitcoin is like gold and it starts to trade at what we would call a discount, I think you're going to see that sort of redistribution there. But on your point on market leadership, let's go to slide 4. So here we see the Mag 7, which is kind of in a holding pattern. And again, there's nothing wrong with holding patterns. Markets don't always go up, and if they do go up too much in a row, it becomes a little dangerous. And we've seen that in recent weeks where, what we call weak-handed longs are just getting complacent. They're just buying everything that goes up, and then of course it doesn't. And so we're in kind of that digestion period or this consolidation period, which I think is good, because shaking the tree of the high flyers once in a while, I think prevents us from getting into a bubble-like situation down the road. But what we're seeing here is the breadth in the bottom. So these are percentage of stocks in the S&P above their 50-day moving average. That's had a pretty good flip there.
Yeah,
Like
sure
it had
has.
been quite weak, became a very narrow market, but it's now flipped from 32% to 60% in just a few weeks. So that bodes well. And if you look at slide 2, which is the MSCI all country world index, that still looks pretty good. Again, the market is correcting, not the end of the world. Markets are correcting 30 to 40% of the time, but the breadth numbers still pretty good. So I'm not concerned in particular about the market. The S&P 500 equal weighted index has actually recovered very, very nicely, as has the cap weighted index. So I think overall, the market is just going through some indigestion. And actually, if we pull up slide 1, you can see kind of not only the S&P, but all the cats and dogs. And you see gold miners, which are not cats and dogs, of course, but they are still up ahead. So that's good for Canada, of course.
Yeah.
The Bitcoin miners have come back quite nicely. That's become a little bit of a hyperscaler play. And so, the markets are doing their thing. And what we can do as long-term investors is to make sure our thesis is still what we think it should be, and then use volatility and adjustments in the market to rebalance. And so that's how I'm looking at this episode.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
The discussion of valuations, and you've long said that, earnings have taken over, and that's, over a year ago, they've done that, and they continue, it looks like, to have the earnings behind them to make the valuations believable, reasonable, and always you cut and slice and dice them with math, they're fine. That said, where does it get extreme? I guess that's the question. The valuations are not extreme enough, it appears, to call this a bubble, but when do they?
Yeah, so valuations are extreme. I mean, valuation is one of those things where it's like beauty's in the eye of the beholder, and a bull can use one valuation metric to make a bullish case, while using the exact same price and the same earnings, a bear can make a bearish case by using a different kind of PE, like a cyclically adjusted PE. But there's no question, if you look at slide 6, for instance, the PE is high, right? The trailing 12-month PE is at 28. The forward PE is around 24. The 5-year CAPE, cyclically adjusted PE, is at 33. That's in the upper percentiles of historical values. And so that is a concern, of course. It's not a good timing tool. Many investors have gone broke, assuming that mean reversion will set in, and it does eventually do so, but usually long after that shop has been liquidated. But for me, the most important thing in terms of the bubble watch is the bottom panel that shows the 5-year change in earnings and the 5-year annualized change in the PE. And again, you look at the late 1990s, and you saw that you had a massive run up in earnings, and then the earnings, they didn't fall, but the growth rate moderated while the PE side took its place, and that created the valuation extreme that we had in 2000. This time around, the earnings are skyrocketing, so that's good, but the valuations, which of course, as we've often talked about, did lead the party, if you will, in 2023 and 2024, are no longer driving returns higher, which is not to say that PEs aren't high, but they're not driving the market anymore. They're basically flat year on year. So this gives me some comfort that we're not at one of those extremes. But then you get into the other question, which is, okay, a 33 5-year PE, what does that mean? And that gets me into kind of the secular story. So if we go to slide 14, I look at the long-term trend. S&P goes up 10, 11% per year. That's the pink rising trend there. But since '09, at least in my view, we've been in a secular bull market. That's the yellow line. And returns have been much higher than the average. They've been more like 15, 16% instead of 10, 11%. And so when I look at the secular trend and I wonder when is it going to end, I look at the price movements. You got that stair step higher, right? Advanced correction, advanced correction. I don't see any reasons to be concerned from that perspective. But then you look at the PE, and it has gone up over the last 5 years. And if we look at the discounted cash flow model, so let's go to slide 15. The discounted cash flow model, or DCF, is a fascinating tool because it's beautifully elegant because it incorporates every variable that you could think of, right? Earnings growth, the payout, the risk-free rate, sentiment via the risk premium. And the way the DCF works is that you look at what kind of earnings are priced in, or you use an average earnings growth of 6, 7%, which historically has been the average. And then you assume that the current price is correct. So as the S&P 6,800, and then you solve for what kind of return is required for that price to be correct given the expectations for earnings. So you get that return. So for the US, using a 7% earnings CAGR, that required return is about only 7%, which is very low. And then you subtract the bond yield, the risk-free rate, and you get to an ERP, an equity risk premium of about 3%. That's very, very low. And if you look at the chart, you have to really squint. That gets you to 2000 levels. It gets you to 68 levels, which were both secular peaks. And to make it worse, at least for right now, we go to the next slide. And when you rank the equity risk premium based on a 6% earnings CAGR, we are kind of in the top 5% or bottom 5% of ERPs historically. And when you look at the forward 5-year returns, they look like they're negative in the blue, but that is against the average return of 10, 11%. So what it shows is that at current levels or lower for the ERP, the market has never outperformed its trend line over the next 5 years ever, which doesn't mean it goes down, but it goes up maybe 7% instead of 11%. And so this is, of course, part of our narrative for the last few years, Pamela, where we've been talking about maybe the beta is going to be harder to get, and maybe we need to, get used to lower betas the next 5 or 10 years and focus more on alpha, which we can get by investing internationally, at least in my view. Now, I'm painting a negative picture, and it's not as negative as that, and I'll explain why. If we go to the next slide, this is my DCF grid. And again, hard to read, but it shows the percent that the S&P is either undervalued or overvalued based on what the market is expecting from earnings and based on the required return that earnings growth rate would spit out based on current prices. So right now, the market is expecting 11 to 12% earnings growth. Historically, it's been 6 to 7. At 6 to 7%, the market is very expensive because the equity risk premium is only 3%. At 11 to 12%, the required return goes up to about 9%, and now the risk premium is about 4.5%, which is much better and actually pretty close to the historical average. So that's a very, very long way of saying that if the market is correct, that earnings are going to grow above trend because of the AI boom or the fiscal bill or whatever the reason is, then the market is not over its skis. But for that to happen, this time has to be different, which are very dangerous words to utter in the market. And that's why I did this analysis just to kind of highlight, like, what do you need to believe to be bullish here, and what needs to be different from the overall long-term history. And I think this kind of peels that onion a little bit.
I mean, in a so-called industrial revolution, which most people think we're in, that would be different this time. But I hear what you're saying. There's a lot in that.
It would be different. And of course, there have been long periods where earnings growth has been above the average, I mean, by definition, and there's been periods where it's been below. So this may very well be a period where we do get, a double-digit earnings growth. And in that case, the market is valued okay. And just to kind of then take the turn the page to non-US markets. If we go to the next slide, which I think is 18, if we look at MSCI EFA,
they're only at
so that's the
8%.
US. Sorry, the previous one was sorry. I mixed up the two slides. So this is EFA. You see that it's priced for about 8.5% earnings growth, and it's trading at a required return of 9.2. So 9.2 less the 10-year yield using the US one, because I'm looking at this from perspective of a US investor buying international instead of US. You're getting an ERP of 5% and an earnings growth, and the market is only pricing in an earnings growth of 9 as opposed to 11 or 12. And so again, to me, this is an interesting and attractive opportunity set because you're getting lower expectations and a higher risk premium, which I think is an attractive setup.
And so this type of, I mean, are we calling this secular, I guess, is one of the questions. The international, the ETHA, maybe even EM, but is this ability to sort of barbell yourself into global stocks, does it feel secular? Because it's been a great year already.
Yeah, I think it is secular. And just by the way, just to put icing on the cake, if you go to slide 19, I gotta finish the narrative. This is EM. EM actually is the earnings estimates are actually about 13% in EM, but the required return is about 11%. So there, which is typical, of course, because EM requires a higher risk premium. And so if we go now to the next slide, which is the last one of this color card spectrum, I'm just putting all three regions on the US matrix, and you can see kind of visually where the different regions are priced. And so to your question, not only are EFA and EM attractive in terms of the fact that their valuations are lower and now their fundamentals are competitive. We've talked in the past about the payout growth being much higher, being competitive with the US, and the payout ratio, at least for EFA, being competitive. But to me, this is a good setup to also deal with concentration risk in the US. So whether the secular bull market is in the 8th inning or whether it has years to go, that doesn't change the fact that there is a lot of concentration risk in the US, with 7 stocks being almost 40% of the market, all tied to a singular theme, which is the AI theme. And, it's been a great theme. The stocks have done amazingly well. They're up 4-fold in the last 3 years. But it is a risk. If you're taking a broad-based approach to investing and you're investing in the US stock market, and you're doing it on a cap-weighted basis, you are going to have concentration risk. And there's going to be a time someday where those 7 stocks are not going to lead the market. And then the market is not going to show a lot of beta because those 7 stocks are going to drag it down. So you could be the best stock picker in the world and have all these great stocks, but the index may not give you much to show for it. And that's where I think this barbell approach of having US cap weighted, where you're in the Mag 7, and then ex-US, whether it's EFA or EM or both, now that those regions are competitive in terms of fundamentals while having much lower PEs, to me, that's a safer bet than needing to kind of tinker within the S&P and going down cap or doing growth versus value, because then you have to make binary choices where you're going to be short the Mag 7. And I don't want to be short the Mag 7 because they've been great winners. So having a global perspective, maybe against a global benchmark, and having the assets more equally distributed, I think is probably as good a way that I can think of as mitigating concentration risk while getting alpha where it can be gotten.
Do you think there's some real, if you take it to the policy side of things and look at tariffs, the world becoming more competitive, can you see a lot of countries perhaps needing a few tariffs in a new way to protect themselves from real competition around the world. I mean, we're talking about it in terms of companies on stock markets that are tradable globally, but there's sort of a reasonable argument, you would think, for why you might want to be a little bit more protectionist, because there are lots of companies doing some of the same things that you could buy on different stock markets, get your grocery store somewhere else rather than the US, and stick with the concentration in the US for the AI stocks.
Absolutely. And of course, this is why there's always been tariffs, right? I mean, It is countries protecting their own industries. And, Europe comes to mind. Of course, China comes to mind. But we are, in this era that is now unfolding of deglobalization and a more multipolar world where it's not just the US as the benevolent force in the world, or maybe not so benevolent force, depending on your view, but where it is now multiple players, of course, namely China, competing for economic dominance, for geopolitical dominance. It's an arms race for AI as well. And the U.S. is starting to play that same game, right? The U.S. has always been about free markets, although it has protected its industries in the past. But we're now getting into a form of state capitalism, right? I mean, the US government owns shares of Intel because it's a national security, or it's deemed to be that. In Holland, the government took over a semiconductor company that had been bought by the Chinese, and they were worried that there was a national security risk there. So I think you're going to see more and more of that. And it may not be in the form of tariffs. It just may be in terms of the state champions getting rewarded or promoted. And that can be very good, of course, but it can also lead to misallocation of capital over time because, the free market system is based on the notion that free markets are better at picking winners and losers than governments. And you can just look at China, at the state-owned enterprises, which have been terrible businesses for a very long time because they were cronies of the communist parties running them, and they were not very efficient. One could argue they were probably corrupt, but that is the state of play, and the U.S. has joined that. And so it could be tariffs, it could be some kind of capital restrictions, or it could just be industries that are protected and promoted for security reasons.
Right. It's fascinating. And I wonder if I can ask you to close out this discussion with the Fed decision in December. We've actually swung around a lot here, but it does look directionally like rates are going down. Tell us a little bit about your thoughts.
Yeah, so slide 9. So it's been a little bit of a flip-flop where you look at the odds of a Fed cut in December. They've been going back and forth because more voices on the Fed have become vocal. And I do think that the Fed is going to stop being the kind of monolithic Fed that we're used to under Powell, before that Bernanke, Yellen, Greenspan for sure. And I think as the Fed gets a little bit more politicized, and it sounds like Hassett is going to get the nod, which I think the market is totally fine with. He's not like a crazy, for the lack of a better word. But you're going to have a Fed where there are going to be board members on there that are going to be sort of pro the administration. And then there's going to be board members on the Fed that are going to be more traditional, status quo, independently minded Fed people. And you could see a Fed that really is more divided, where you have kind of like a Supreme Court-like outcome where it's, 9-7 or something like that. And right now, market is concluding, based on what John Williams at the New York Fed had said, that a rate cut is happening. And if you look at this chart closely, you can see that there's an index, an inflation index called Trueflation, which is a live, real-time daily index. You can get it on your Bloomberg. And the rate of change for that inflation index is 2.4% year over year. And it's been really in a sideways pattern now for a number of years. And so between that and the jobs market, not quite stalling, but certainly not being robust, you could argue that, okay, neutral, I have it kind of closer to 4, the Fed has it closer to 3. kind of the Trump people at the Fed have it closer to 2. But you could argue the Fed can go from 3 7/8 to 3 5/8 and not really do any damage. Like it's not going to cause a bear steepening or anything like that. So I think the Fed, like I don't see the urgency to do it, but I don't see any harm in it either. So I think at this point that's the going rate, if you will. But more importantly, I'm looking for the number of dissents and more vocal voices within the Fed, where it's no longer everyone just kind of adhering to whatever the chairman says.
Right, it's fascinating and changing times there. Certainly, Jurrien Timmer, we're so grateful that on your many stops around the world, you're still including us. Have a great week.
Thank you. See you back in Boston. Me back in Boston.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.